Right, welcome to the solution to problem 12-1 located on page 597, preparing a segmented performance report. So we've got a bunch of information here. We've got sales figures in units and so selling price and then variable cost per unit and so on. And we need to prepare a segmented performance report using exhibit 12-3 as our guide. And that is on page 575. So that's essentially what this is going to look like. And as you look at that, you'll notice we've got, we're taking essentially each segment or business unit down to contribution margin, and then we're adding traceable fixed costs. So those costs that can be directly, that are caused by the segment or the division to a point where we get something called the segment margin. And then from there, after that, we're going to list out common fixed costs and get a net income overall. And so that's the kind of thing we're about to do for Prairie Electronics located in Regina. All right, so we're going to start with speakers, no, bit tighter. Personal computers, handheld devices, and total. Okay, and so from here on in, it's basically just math, right? We've got from the book 340,000 units times 1,500 per unit gives us 510 million for this here. So, and for personal computers, 550,000 times price of $12.50 each gives 687 500,000. Handheld devices, 440,000 times 375, 165 million, for a total of 1,362,500,000. Okay, and then we're going to do the same thing for each variable cost. So we've got direct materials, number of units, 340,000 times, the book tells us $426 each. So that gives us 144,840 to 11,200,000, 17,600,000, and add that up and you get 373,640. Direct labor, $40,800,000. 500. 120 for a total of 177,420. So now variable overhead 27,200,000, 60,500,000, 16,280,000 for 103,980. Now no longer product costs, we're under period costs, but they're still variable. So shipping, 10,200,000. $460. And then lastly, I think we've got sales commissions here. $6,800,000, 11,880,000 for 18,680. And that gives us contribution margin. So 280,160, 272,800,000, 107,360 for a total of $660,320,000. Okay, so that gives us contribution margin. Now we've got to deal with these traceable or direct fixed costs. Less what they're calling in the book, direct fixed costs. And so we have salaries, utilities, and amortization. So again, remember, these are fixed costs in that they don't vary with the amount of production, but they are traceable directly to these segments, and therefore it's appropriate to include them as segment costs instead of common costs. So we're looking at salaries, 61,560,000, 70,250,000, 40,330,000 for a total of $172,140,000. All right, utilities. $41,250,000, $55,005,000, $12,500,600 for a total of $108,755,600, and amortization 59 and 250, 112,600, 30,250, 201, 850, 250. Okay. So subtracting all of those from our contribution margin will give us a segment margin. We could subtotal them and get total expenses, but we're not gonna bother with that here. We'll just go with segment margin. So again, 280 million minus all of these gives us a segment margin of 118,349,750. 34,945,000, 24,279,400, for total company wide of 107,320,000. $77,574,150. Okay, so this now gives us a sense of where we're at for each segment, but we have still these common fixed costs. And the whole point of doing a segmented income statement like this, or segmented performance report, if you will, is to ensure that the common fixed costs are not allocated to the individual division. So right now, we can tell from the way this is presented that each of these divisions contributes a certain amount towards covering the fixed costs and eventually the total profitability of the company. So the common fixed costs are not avoidable. If we get rid of one of these divisions, we're not going to avoid the fixed costs. So just like we learned in Chapter 9 about relevant costs, we know that these will continue to add value, even though if we succumb to the temptation, which some businesses do, of allocating the common fixed cost to each division, we could turn this report into something that looks like these two in particular are losing money. But by virtue of keeping the common fixed cost common and not allocating them out, we can then show with clarity that we're actually not losing money, or these divisions are not losing money. They are contributing to the overall well-being of the corporation. So, common fixed costs, we've got corporate salaries, we've got building amortization, and we've got legal and accounting. Okay. So, corporate salaries, $33,460,000. Amortization, $27,900,800, and legal and accounting, $41,380,640. Oh, there's another category in here too. Not sure what that is, but that is $11,347,060. Okay, so subtracting from the 177, each of these gives us a net income at the end of the day of $63,491,950. Net income. All right, so that answers requirement number 1. Number 2 says compute the contribution margin percentage, contribution margin divided by sales, and segment margin percentage on the basis of the dollar amounts and percentages. How would you assess the performance of the 3 segments in the report? Okay, so we can just do that here quickly. Contribution margin percentage and segment margin percentage. And so again, this would be, contribution margin would be 280 divided by 510, segment margin 118 divided by 510. And so the percentages work out to as follows: 54.9, 23.2, 39.7, 5.1, 65.1, and 14.7. So that's the computation of them. And I think we'll discuss the second part of question 2. It says, on the basis of the dollar amounts and percentages, how would you assess the performance of the 3 segments? We'll do that in part 2 of the solution.